This presentation is about my experience with How the Market Works, a simulated investment portfolio competition that we did as a class. Yahoo Finance became my primary tool throughout the competition because it quickly allowed me to analyze stock performance, analyst ratings, market news, and earning reports all in one place. The consistently on pace of it also proved vital in helping me track the pulse of what was happening. My initial strategy focused on industries and companies I personally understood. I invested in healthcare, energy, technology, and media companies, while also keeping a mutual fund position for stability. I also paid close attention to current events and marketing sentiment when making my decisions. I attempted to balance safer long-term investment with higher risk growth opportunities. Diversification did help protect my portfolio, but speculative positions still had a major impact on overall performance. My portfolio experienced both strong gains and significant losses throughout the quarter. While some investments performed very well, the volatility of speculative trades and market timing mistakes caused my overall return to end slightly negative. Perhaps the most funny of it all, my best trade was simply my total market fund. So that adage of you cannot beat the market was absolutely true in my case. My strongest investments were mostly large technology companies with strong financial performance and long-term growth potential. These companies tended to be less emotional and more fundamentally driven. It is no mistake that two of these stocks are part of the Magnificent Seven, the stocks that have outperformed the S&P 500 by over 6% over the past 10 years. There's part of me that wonders if this would have gone differently if I just had stuck with the Magnificent Seven from the start. One of my biggest lessons came from speculative investments, and I wanted to use my story of Figma as an example. Right when we started the simulation, the stock was dropping due to market speculation. Google and Anthropic had just introduced new AI-powered design tools, and using Figma every day in my own job and knowing how important it is for digital product design, I knew this was just a market overreaction due to lack of knowledge. Meanwhile, at work, I actually got access to the Google and Anthropic tools to help evaluate whether we should buy enterprise licenses for them. I'm not going to argue how good they are, but I will say it was extremely clear that they were at best a different tool than Figma entirely, but not a replacement for it. At best, it was for a different set of users that would likely not displace existing designers. This definitely made this big imaginary loss even harder to swallow. Though running the numbers later on in the course, I learned Figma was in a good position. They have gross margins of 82%, 46% revenue growth year over year, and extremely low debt, but their future prospects were not perceived well by the markets. So I cannot plan to know the future of Figma, but this loss was tough. So I know it's said all the time, but the market is not rational, and that was a lesson I had to learn for myself. Some key ratios that stood out to me over time when evaluating stocks were price to earnings, how much investors are paying per dollar of earning, return on equity, how efficiently does the company turn shareholder money into profit, and debt to equity, how much debt is the company carrying versus what shareholders own. Two of my best trades during the class were Microsoft and Alphabet. You can see that they increased 19 and 40% since the class simulation began. They had excellent marks in every one of these ratios, further reaffirming their importance. When I started this quarter, my strategy was focused on emotional conviction, news cycles, short-term events, and speculative rebounds. Over time, I shifted to proven large-cap tech stocks, financial fundamentals, stable companies, and long-term growth. If I could restart this quarter, I would move towards financially strong growth companies much earlier, instead of relying on speculative recovery plays and emotional conviction. It was clear that I was not a leader in this competition, but I did learn a lot. This competition taught me that investing is not just about predicting what will happen next. The strongest companies are built around research, long-term thinking, and disciplined decision-making. At the same time, it was interesting to still see how much market speculation was not driven by rational thinking. Some of the steadiest companies that will see the rapid price growth are more hyped than the ones that will. For me, I learned a career in day trading was not for me, and I'm best sticking to mutual funds for my own personal investments. But it was absolutely eye-opening to see how close the value of markets were actually determined. And being able to do this while both a war and an AI hype cycle was running through the markets was also incredibly informative. Thank you.